Welcome to The Business from Perth. I'm Rachel Papazoni. Coming up on the program, the end of JobKeeper. Business insolvencies set to rise as 1 million workers say goodbye to the wage subsidy.
We would be struggling, really, and we would be struggling to sort of pay the wages, pay the rent, pay the other bills.
And does record stimulus plus an economic recovery equal a commodity super cycle? South 32 is standing by.
More medium term, we're quite excited, if you like, by the opportunities we see in this space, particularly in the base metals.
But first, AMP is again in the spotlight as the board considers the future leadership of the company. Last week it was forced to affirm to the market that Francesco Di Ferrari remains as chief executive for now, after media reports his resignation was imminent. Yesterday, the exclusive deal period with US investment firm Ares, considering a 60% stake in AMP Capital for $1.35 billion, ended. But no deal has been announced, raising questions if it will go ahead. I spoke with Forager Fund Management's Chief Investment Officer, Steve Johnson, from the studio. Steve, is AMP on a slow road to self-destruction?
Yes, it is, but it's been on that road for a very, very long time, and it feels like a spaceship that's drifting out into space very slowly and has no power to turn itself back around.
There's clearly uncertainty about the future of Francesco Di Ferrari. How damaging is that toing and froing for the AMP Capital deal?
I'd say in my 25 years of financial markets, I don't know that I've seen a saga providing as frequent a drama as this one, and this is just another phase in it of bizarreness in terms of announcements around the CEO. I think it is disruptional in terms of their ability to sell assets, but I think more importantly, it gives the people buying those assets more leverage to squeeze them on price.
AMP now saying that Ares is interested in 100% of the AMP Capital business. Is it the best move for AMP to be selling off the best part of its company?
I would say it's completely price dependent. I think if they can get the right price for the asset, then it may fix some of their problems. And I think AMP, as it stands today, is not going to create value for shareholders. So it needs to be broken up, and I think the component parts need to be sold to people who can maximise the value out of those assets. I'm very worried that in this environment, though, they're going to get a suboptimal price for that asset.
If Ares pulls out of these negotiations, do you expect that another buyer would come forward?
There are plenty of people sniffing around the carcass of AMP, so yes, there will be buyers. The problem is at what price? And I think with any of these situations, the management team here really needs to focus on turning the business around, creating some operational momentum and giving themselves some leverage in the negotiations rather than being a desperate seller.
Looking at AMP more broadly as the entire company, what does it need to do to save the remainder of its business?
One thing I think is really important here is to get some shareholder representation at a board level. I think at a director level and at a senior management level for a long time now, you've had no one that owns any shares in the business. And there's a lot of risk aversion because of that. There's a lot of worry about reputations, but there's not enough focus on creating shareholder value. They need to get this business down to being competitive in terms of offering low fee products, and therefore they need to try and hang on to as many clients as they can. The one big asset that AMP has got is the lethargy of its customers. It's still got a huge customer base. It's still got hundreds of billions of dollars of funds under management. So there is an asset here that can be saved, but there's a lot of work that needs to be done to save it.
AMP has made a number of big cultural blunders, not least of which involve sexual assault allegations and how it dealt with them. Do you think shareholders would be satisfied AMP has done enough to address its cultural failings?
No, and I don't think it is just related to the issues that you've raised there. I think those cultural issues go across the organisation and towards some of the financial side of things as well. I think there needs to be a reflection in this business that times have changed and that you can't run a funds management business the way you ran it in the 1990s, and you can't run a financial services business the way it was run back then either.
Steve Johnson, good to get your insights. Thank you.
Thanks a lot.
JobKeeper is over. The mammoth scheme, using $90 billion in taxpayer funds to subsidise wages, supported almost 1 in 3 workers at the height of the pandemic. 1 million workers were on JobKeeper as it finished up yesterday, leading to concerns about the impact on the economy as businesses, propped up for a year, start to fall over. Meanwhile, Brisbane is entering a snap 3-day lockdown, the first without the wages safety net. Daniel Ziffer reports.
In outer suburban Melbourne, in Dandenong's Little India, things are buzzing in Steve Kahn's barbershop. But it's quiet outside. JobKeeper saved his business when the pandemic hit and people were forced to stay at home.
It was such a scary time at that time because we didn't know, really, because there was no income, no people on the streets, no nothing.
Mr Kahn has already reduced his staff from 13 to 5 and closed a grocery store. The businessman is weighing up what to do now the JobKeeper wage subsidy is finished.
We would be struggling to sort of pay the wages, pay the rent, so there's a lot of expenses. So I don't know, let's see, so we hope for the best.
This has always been a temporary program. This was always an emergency payment. And at $90 billion, it's the single largest economic support program that any Australian government has ever undertaken.
At the height of the pandemic, JobKeeper was supporting 3.5 million workers, almost a third of the workforce. Those numbers have fallen as restrictions have eased, confidence lifted, and the economic recovery has begun. But as Brisbane's lockdown shows us, things can change overnight.
Look, this is going to be part of the Australian way of life until everyone is vaccinated.
When JobKeeper ended yesterday, there were just under 1 million workers relying on it. Treasury estimates 150,000 of those people could become unemployed.
And there will be an inevitable job losses, and there will also be business closures. Presently, we just can't say the extent of it, but that will be the result.
Insolvency expert Kirsten Farmer is preparing for what she calls a gentle wave of companies going into administration. Insolvency laws were essentially suspended last year. So despite the recession, the number of companies going under actually fell by half.
Those that have been relying solely on JobKeeper, those are the ones that will collapse immediately. But the others, there will be a gentle, slow workout of what their position is.
Adrian Hunter, partner at insolvency firm Brook Bird, agrees.
I don't think there's going to be the same level of shock and awe happening within the wider community. These businesses haven't traded since last year. They've driven past that shop, that outlet. Yep, they've moved on and they've already adjusted their own business to realise that that debt's not going to be recoverable.
His firm was one of 900,000 businesses that used the scheme to keep staff employed when economic demand slumped during the crisis.
It enabled us to keep all of our employees on the payroll, replicated across many Australian businesses. And so, yes, I think it has been successful, but how long can it keep going?
Expert advice is consistent. Businesses that seek help earlier have more options.
And what we're hoping to see in this time is for those companies that do have some cash and do think they can hang on to go and get some expert advice sooner rather than later.
For small business owners like Steve Kahn, it's going to be a tough April.
It's really been very, very helpful, and it's very unfortunate that they are sort of stopping it in March.
As we move into the second year of living with COVID-19.
Daniel Ziffer reporting. Despite prices for commodities like iron ore and gold soaring since the pandemic outbreak, BHP spin-off South32 reported first half profit was down 46%. But the miner says it's now starting to see more of its diversified minerals, including nickel, lead and manganese, experience an uptick in price growth. Boss Graham Kerr says recovery out of the COVID-19 health crisis in many of the countries South32 operates will be a key factor in the miner's future. I caught up with him here in Perth. Graham Kerr, welcome to the business.
Thank you for having me.
Graham, we've seen commodity prices soar in the last 12 months. Are we in the midst of a commodities super cycle? Is this a fad?
Look, it's a good question. I mean, what we are seeing at the moment is unprecedented levels of stimulus being poured into the different economies. The US now, after China's been doing it for a period of time. I think it is actually obviously boding well in the short term if you have mineral commodity exposure. But I think more medium term, we're quite excited, if you like, by the opportunities we see in this space, particularly in the base metals. So you're talking about the copper, the nickels, the zincs. You know, not only is there strong demand for those products as the world continues to decarbonise and goes green, there's actually less supply because there's been less development of new projects, less money invested in exploration. So there's a real gap, if you like, presenting itself.
Your results, though, didn't really show too much benefit from that upturn in the commodity cycle. What are you trying to do to turn that around?
I think a little bit of that is timing. So we had a nice chart in our slide presentation pack that sort of showed prices where they were at February, so a couple of months ago, where they were at the start of the year. There's been a mass move, if you like, in many of our commodities over the last couple of months.
Demand for battery materials is growing and is just going to continue to grow. What are you trying to do to expand in that space?
Look, we talk a lot about the bias to base metals. Part of that is because the minerals that we produce, manganese, hopefully copper and zinc, they all play an important part of that battery evolution. Not always necessarily in the battery, but particularly in some of the lightweight metals that will be used in vehicles and transportation that allow you to actually use batteries. I think at the same time, the Clark deposit, which we have in the US, in Arizona, is a manganese oxide, which potentially is a precursor to a battery material. We've been working with Tesla on some of the options around that.
We're in Western Australia, probably one of the few places in the world that's fared okay out of the COVID crisis. But of course, South 32 has operations in places like South America, South Africa, where the situation has been very different. What impact has that had on your operations?
Perth, being one of the most isolated cities in the world, really has benefited from that. And you know, we've virtually had no COVID impact here. If we look at South Africa, Mozambique, Colombia, Brazil, even Arizona, places where we operate today, it's been hit hugely by COVID-19. And to put it in perspective, you know, we've had 29 of our people who have caught COVID-19 and passed away, but that's the tip of the iceberg when you think about the families that have been impacted and are broader than just our own employees. We've managed to actually continue to produce through that despite some of the challenges. One of the concerns I have is going forward is that gap, if you like, between the developed and the developing world. I have a fear that will actually get worse through COVID-19, particularly as you see about how the vaccines get rolled out and how some of those countries rebound, because every country around the world has injected stimulus. Some countries can afford that more than others.
We are starting to see some slow recovery out of COVID and a little bit of a turnaround in some parts of the world. How is South 32 going to capitalise on that? What do the next few years look like for you?
The recovery, we are seeing that in obviously, you know, places like the UK, the US with vaccination rolling out. Probably not quite there in South Africa. We're coming off the back of a third wave. Mozambique still having some of those challenges. And if you look at the statistics coming out of Brazil at the moment, it's horrific. So I don't think, you know, all the world's past this. I think, again, what we try and focus on is making sure that our people are safe and well, that our plant is stable and reliable and supporting our communities. And then if basically we see strong prices come through like we've seen over the last couple of months, you know, we'll focus on basically generating as much as we can out of our operations to make, if you like, take advantage of those prices, but certainly not at the disadvantage of supporting our people. That comes first and foremost.
Graham Kerr, thanks for speaking to the program.
Thank you, thanks for the time.
To the markets, and oil prices eased on news the Ever Given has been refloated in the Suez Canal, though it's still not clear when the trade route will reopen for traffic. Shares in Mortgage Choice shot up by more than 60% today after news it's in initial talks to be bought out by REA Group for $1.95 a share. The All Ordinaries and the ASX 200 both slipped by 0.4%, and the Australian dollar is lower against all the major currencies. And that's all from the business, coming to you from Perth. For more on those stories, head to our website and click on the business page. And you can catch up with the program anytime on iView. I'm Rachel Papazzoni. Thanks for watching.